3 weeks ago, the US and Iran signed a ceasefire at the Palace of Versailles. This week, it opened fire on the tankers that ceasefire was built to protect. This isn't a war restarting. It's proof it never actually stopped. And the people who saw this coming weren't in Washington or Tehran. They were a room of insurance writers in London, and they never once dropped their price. If you've paid for gas, groceries, or a flight anywhere in the last 4 months, you already paid a small piece of this story. You just never saw the receipt. So here's the receipt. For decades, the Strait of Hormuz has carried roughly a fifth of the world's oil and gas, about 20 million barrels a day squeezed through a channel 21 miles wide. We covered this choke point in an earlier video. We told you then, it has no backup plan. This year, the world found out what happens when someone actually tests that in real time. Now, quick ask, if this is useful, hit the like. It's the fastest way this reaches more people, and we publish multiple times a week, so subscribe if you want the next one. Here's what almost nobody outside shipping actually understands. Think about home insurance. If your street has never flooded, your premium is pretty small. The moment a storm hits 3 blocks over, every insurer on your street raises your rate, whether your own house took on water or not. That's not overreaction, that's the entire model. Marine war risk insurance for oil tankers runs on exactly the same logic, just with $200 million ships instead of houses and a choke point instead of a street. Before this war, insuring a tanker to cross the Strait of Hormuz cost about 1/4% of its value. Routine, almost invisible. By March, that same insurance cost up to 5%. On a $200 million ship, that's a difference between $200,000 formality and a $7 million bill per voyage. The war started in February 28th when America and Israeli strikes killed Iran's supreme leader in the opening hours. Iran answered with missiles and drones across the Gulf, and within 2 weeks, the strait was effectively a war zone. Lloyd's of London's Joint War Committee, the body that decides which waters count as too dangerous to insure normally, expanded its war risk zone within days. Oil, which had been trading in the 60s, hit $126 a barrel, the largest single-month price jump ever recorded. Tanker owners who kept sailing paid it. Daily charter rates on some routes quadrupled toward $800,000. Ships that didn't sail just waited. At one point, close to 400 vessels sitting in the Gulf going nowhere, insured or otherwise. And these weren't abstractions. A Thai bulker was hit by 2 projectiles. A tanker under the Marshall Islands flag lost a crew member. An Indian cargo ship went down after a drone strike. This was happening to real crews in real waters while the world argued about ceasefires on dry land. The US answered by blockading Iran's own oil exports in April. Iran answered by keeping the strait unpredictable. Both sides were testing how far they could push before the other blinked. Then, in June, it looked like it ended. An actual ceasefire, a signing ceremony at Versailles. Traffic through the strait started climbing back, over 90 ships a day, still below normal, but recovering. The insurance premium did not recover. It stayed 4 to 8 times higher than before the war, through the entire so-called peace. Everyone else acted like the war was actually over. Saudi Arabia cut its official oil prices by the steepest margin in more than 20 years. A bet that calm was here to stay. JP Morgan, Barclays, Morgan Stanley, and UBS all cut their price forecasts for the next year. And the US government's own energy agency cut its forecast as well. But then, on July 6th and 7th, Iran fired on 3 commercial tankers in the strait. The United States revoked the license that let Iran sell its oil at all and struck more than 80 targets inside Iran in response. And at a NATO summit in Turkey, the president said the quiet part out loud. As far as I'm concerned, it's over. Oil jumped more than 7% in a single session, not over months, in hours. The peace wasn't broken, it was never load-bearing, and everyone just built on top of it anyway. And the deeper problem never moved. Whatever any memos said on paper, Iran still controls the only water the ships can use. That leverage was never something a signing ceremony could ever take away. And now, This week, the pattern is repeating in real time. Iran is threatening to shut down the strait completely if the US strikes again. The president has floated reimposing the naval blockade and even taking Karg Island, the terminal that ships 90% of Iran's oil, outright. Iran has already answered by hitting targets in Kuwait and Bahrain, both US allies, both housing American bases. This isn't staying contained in Iran and the strait. It's beginning to spread. Traffic through the strait has nearly stopped. On July 9th, only 2 tankers moved through in the early morning hours. A day early, it was nearly 50. Nearly 6,000 sailors are stranded on ships in the Gulf in the making of this video, waiting to find out if the water in front of them is safe. If you own an index fund or a target date retirement account, you already own a piece of this. Energy is one of the largest sectors in the S&P 500, and its earnings move on exactly the numbers we have just been walking through. Zoom out a bit further, and the number that actually ends the argument isn't the oil price, but it's this. The war has already cost American taxpayers more than $113 billion. And with an analysis of the shipping data found, the United States and Russia, not any Gulf producer, were the 2 biggest financial winners of this disruption so far. By May, the closures alone had already erased more than 1 billion barrels of oil from the market. With another 100 million barrels lost every additional week, the strait stays shut. Meanwhile, Europe is living through a second energy crisis in 3 years. Gas benchmarks nearly doubled inside a single month, and the European Central Bank pushed back interest rate cuts it had already promised. In Latin America, the same barrel of oil means opposite things depending on which side of the ledger you're on. Brazil and Venezuela are booking windfalls as exporters, while countries that import their fuel are eating the inflation. And in the Gulf itself, the UAE is racing to finish a new pipeline that would let it move oil around the strait entirely. Real construction, roughly half finished, due online sometime in 2027. At the same time, architects have floated a $200 billion canal dug straight through a mountain rock to bypass the strait for good. One of those is actually being built. The other is just a rendering. Neither one replaces 20 million barrels a day because you can't engineer your way out of geography. We already told you this is a choke point with no backup plan. And this year, with an actual war restarting around it, the world tried to buy one anyway, and geography still said no. So here's what actually matters underneath the headlines about ceasefires and summits and threats. The oil price is not the signal. The ceasefire announcement is not the signal. The signal is what insurers in London are willing to charge to put a ship in that water, because they have no incentive to be optimistic and no political reason to pretend. Right now, that number is still 4 to 8 times higher than peacetime. It never came down, which means, as far as the market that actually prices this war is concerned, it never really ended at all. So, don't watch the next ceasefire announcement. Watch the war risk premium. The day that number actually falls back towards normal, that'll be the day you know this is really over, but not before. If this gave you a clearer picture of what's actually moving underneath this war, hit that like button. It's the single biggest thing that gets this to more people. And subscribe. We publish multiple times a week. And let me know in the comments, do you think this ceasefire is really dead, or does it get patched together one more time?